Hi everyone, welcome to Hack the Bank, Strategic Financing for Growth and Contract by Edward Darrow. This is Irene Cho. I'm your host. Today cover funding the wind, capital for contractors and procurement. This webinar is brought to you in partnership with EWDD, BusinessSource Center, Pico-Union Westlake region operated by PACE Business Center. This webinar will be recorded and you may find it on our website e-library after a week or two. If you have, during the webinar, if you have a question, just please use the chat box and then writing your question, and then Edgar will answer at the end of time. Before we get to the topic of the day, I would like to introduce PACE briefly. PACE was originally founded in 1976. We are a nonprofit organization. Our PACE BDC provides many counseling service for local small business owners. We also provide various loan program you can apply for your business. So if you have any questions, please feel free to visit our website, pacebdc.org, or give us a call. We have upcoming webinar regularly, so you can always check our webinar and register. Past webinar recordings, please visit our website. Please give us some time to our marketing team to upload the recording. It may take about 1 or 2 weeks. Okay, now let's get started on today's webinar. Please welcome Edgar Darrow.
Thank you, Irene. Welcome back, everybody, to our part 2 of our webinar series called Hack the Bank. For those of you who missed last week, I'm your presenter today. I'm Edgar Darrow, Commercial Loan Advisor. And let's kick off things today with a scenario. I know most of you who have lived this through. It's Friday afternoon, and you finally get the call. It says, "Congratulations, you won the bid." You celebrated all weekend, but Monday morning hits, and suddenly reality sets. To start the project, right, you need materials, equipments, and a bigger crew. But the client, they're not going to pay you your first invoice for 60 or maybe 90 or even 120 days. So you got the win. Now what? That's exactly what we're tackling today, funding the win. And like on the slide that says, this brings us to the elephant in the room, the cash flow gap. How in the world do you pay for materials and labor before you actually getting paid? If you just rely on the cash sitting in your checking account, you're going to strangle your own growth. Today, we are going to look at the real tools contractors use to bridge that gap. We're going to cover mobilization capital, factoring, revenue-based financing, supplier credit, and ledger lines of credit. Also, we're going to talk about why a standard SBA loan you always hear about might actually be the absolute wrong move right now. So let's get to the next slide, mobilization capital. Think mobilization capital as your rocket fuel. This is a short-term funding meant specifically for covering those painful upfront project costs before the very first invoice gets paid. We're talking about your labor, renting your equipment, paying for your insurance, and buying those initial materials. The beauty of this tool is that the lender issues the funds right at the start of the project. It's not towards the end. So, and here's the kicker. The repayment schedule is actually aligned with your project milestones. So when they advance your funds and the repayment is actually coinciding with your project payment or milestones. So the whole point here is to prevent you from stretching your everyday operational cash reserves so that you're not too stretched out during those first 30 to 60 days of a new contract. And, we know all about that. Now, all right, let's talk about the next slide, which is factoring and PO financing. With invoice factoring, you already done your part. You delivered the goods or services and you've issued your invoice. But you can't wait 60 days or 90 days for the cash. So what do? So you literally sell the unpaid invoice to a third party at a discount. So the third party is mostly a commercial finance company. And in exchange for that, you get immediate cash. Usually, the advance rate on that is 70 to 90% of your invoice amount. And it's a brilliant way to accelerate your cash flow without strapping your business with long-term debt. So this is a short-term debt. But there's a catch, however. Factoring relies heavily on the credit worthiness of your customer, not just you. So what it means is that they would prefer that your clients or your customers are credit worthy, meaning A rated or something rated, within the business community. It also involves a third party notification, which means that your client or your customer is going to know you're factoring your invoice because usually they will get a notice saying your account has been assigned or we're doing the collecting of the account on your company's behalf. So that's what they will know. With PO financing, similarly, it's usually paired with factoring, so they come hand in hand. But if you're, a general contractor or a subcontractor, PO financing or factoring is generally not a suitable product for a loan in your field. You also need a higher margin to even qualify for this type of product. The next slide that I want to talk about is, the thing that mostly is rigged with against most contracting business. So most contractors do not qualify for traditional bank financing. The reason why is because the nature of your business. Bank and factoring companies like things clean and simple. But with construction, it's a little bit messy. You guys deal with progress billing. You also deal with crazy long payment cycle that can stretch over 90, even 120 days. And the biggest headache for a traditional lender for contractor is what they call mechanic liens. These are liens that are placed by the contractor for a project. And it usually is filed along with other filings. So with those banks, they like to see it clean and they will have a priority assets over their filing so they can protect themselves. So those are some roadblocks to the contracting business when you get some business capital. So if the traditional bank says no, what actually works? So on the next slide, I'll show you some of the specific hack for contractors or subs in the construction industry or project management. First, let's look into contract financing. This is a product where lenders will actually advance their money against your signed contracts, your progress billings, or your project milestones. It is heavily used by subs and government contractors, and you can sometimes get an advance up to 85% of the contract value. So the difference between contract financing and factoring is that they will look at the signed project as opposed to an invoice. So when you sign an invoice, you have completed the product, right? But there are mechanic liens that prevents you or that prevents a lender from perfecting their filing on your business assets. So whereas a contract financing, they look at the contract itself, right? The second one is if we go back to the previous slide, is equipment financing. So if you need heavy machinery, lenders are often uh, asked to apply for quick applications to acquire their equipments. So this is good news for contractors because if you need materials or you need equipments right away, you can get a lease or a purchase financing with a simplified application. Usually, if you have good credit, you can potentially get up to 100% financing. If you have, a fair score, fair credit score, you can still get financing, but you may have to put, some down payment or put a deposit on a lease. And for those that are more established, meaning 5 or more years of business and financial are strong, they can look into an asset-based loan or line of credit or what they call ABL. So this type of financing is a combination of your receivable contracts, equipment as collateral. So they look at holistically at those to give you the amount of money that you need. Now, I want to take a quick detour of the source of funding, but this is a bonus hack. Did you know that business credit cards are one of the best kept secret in business funding? A lot of business owners overlook this, but they do not know what it offers, as far as what the benefits are than your personal credit cards. Usually, the paperwork requirement is incredibly limited. And the absolute best part of this is that this particular debt does not appear on your personal credit history. And also, if you need to float material purchases for 30 days or more, this is a fantastic and fast tool to use. So, uh, if you're thinking about the business credit card option, the following slides will give you some ideas depending on your credit profile. So the first slide here is for credit cards that are good with contractors with good credit. So as you can see, I don't know if you can see it, Chase Inc., American Express, Capital One Spark, the Inc. Business Unlimited credit card, and the US Bank Triple Cash Rewards are one of the finest out there for those businesses whose owners have good credit. And this is not a recommendation. This is just, a compilation of the best credit card programs out there for someone who has good credit. The next slide is for some business owner who has some, decent, fair credit score, not good, not bad, usually within the 650 to 690 range. Uh, Capital One Spark, Classic for Business is a good option. Inc. Business credit card, I think this is also a good option. The Wells Fargo business secured credit card. So with a business secured credit card, you would have to put a deposit initially. And then, once you build up your credit history, then you can go ahead and get an unsecured business funding. American Express Business Gold Card is also a good source for that, for someone who has, okay. So we're now looking at the credit cards with bad credit. So Bank of America Business Advantage Unlimited, Valley Business Valley Visa Secured Business Credit Card, Discover Security Card, and the Brex Business Card. Brex Business Card is not usually a credit card, but it's more of a charge card per se. So it handles your expenses. It tracks your expenses so that you can enhance your cash flow projections and whatnot. So those credit card deals can actually get you up to maybe 50,000 or even more, depending on your credit. Usually, the credit cards are basically higher than your normal personal credit card. So next slide will tell you more about revenue-based financing. So this is an upfront capital injection to fund your growth up to the point of contract execution. Instead of a terrifying fixed monthly payment, your repayment is just a fixed percentage of your weekly or monthly gross revenue. This means it's totally flexible. If you have a massive revenue for the particular month, you pay more. If you have a slow month, because of weather delays or whatever reason, you pay less. So your payments are not fixed. It's based on your revenue. So the higher your revenue, the more you pay. The less your revenue for a particular time, the less you pay. Now, bear in mind though, with RBF, you do need a strong gross margin to absorb the cost of this capital, because it's not, the cheapest money out there. But the trade-off is that your personal credit scores are secondary, and the underwriter's primary focus for this particular program is purely on the health of your business bank statement. So they do some sort of a projection type of deal based on your monthly bank statement. So if you have revenues for this month that is high, then you have a certain percentage that they take out. If it's low for that particular month, they also have a percentage with less revenue for that particular month. Now, for our next slide, uh, if you hate the idea of your clients knowing you're financing your invoices, like we discussed on factoring, because they will be notified, right? Let me introduce you to the ledger line of credit. They're also known as accounts receivable financing. This is a revolving line of credit secured by your accounts receivable. The banks usually, or the lender usually establish a borrowing base between 80 to 90% of your current accounts receivable, minus any accounts that are over 90 days past due. Like I mentioned earlier, the huge advantage here over traditional factoring is that a ledger line is usually a non-notification. So your clients won't know that you are factoring or you're financing their receivables. You keep 100% of your accounts, as opposed to factoring where you're selling your accounts. So those are the basic difference. Some bigger construction companies are eligible for AR financing. Startup or a relatively new business in the construction field probably wouldn't qualify for a ledger line of credit. Now, uh, going to the next slide, which is the supplier credit. This is also known as your trade credit. If you use it properly, it is incredibly effective. If you build a strong relationships with your vendors, you can preserve your capital by negotiating net 30, net 45, or even net 60-day term. Think about what that really is. It's zero finance interest on a short-term loans. It allows you to take materials, put them to work, and actually generate revenue from them before you actually have to pay your supplier. So it's a best way if you can use it effectively. Now, the next slide is a step-by-step guide on how AR financing or factoring loan requests are processed. As you can see, the process is streamlined, beginning with the application, which usually is just recent financial statements and aging reports. Unlike when you apply for a bank loan or a business loan, typically they're asking for the whole 9 yards, right? The tax returns, the bank statements, the financial statements, the balance sheet. And if you're kind of pressed for time, with this project, you really don't have time to do that. So, uh, AR financing, the process is a little bit simpler. So you submit the application, like I said, usually with the bank statements and your financial statement, P&L and balance sheet. The lender will usually do their due diligence relatively quickly, within about 2, 3 days. They'll look at your credit worthiness. They'll also look at your, especially on the factor or AR, they will look at your account concentration, meaning do you have any ARs or receivables that are concentrated in just one customer, or are they spread out to many, many customers? A factor also will consider your customers' credit worthiness. Are they rated? Are they a big Fortune 500 company, or who do you deal with? So usually they will order a credit report of your customer, a credit profile. And the beauty about this, like I said, it's quick. They use the updated technology to handle all of this within a matter of days. So once they review it, you get approval if you like it, then you sign, with their terms and fees. Then you submit an invoice. As when you sell your factor, you submit an invoice. You get your money, within usually 24 to 48 hours. And then the factor will then invoice your customer after 90 days or 60 days, whatever your terms is with them. And then when they receive the funding, they will subtract what they advance to you, and then you will get the difference minus whatever fees you agreed upon. So that's how easy it is to get factoring or AR financing. Now, like I mentioned, the biggest roadblock for contractors is the type of business itself. So, but there are companies out there that specialize in contract financing, which is similar to this, and the process is also the same. So finally, I want to address the elephant in the room. You hear about SBA loan thrown around as the holy grail of business lending, and they are great, but there is an SBA mismatch when it comes to government contracts or construction business. Traditional SBA loans fall short and trap you in a few ways. First, the timeline trap. The speed of funding is usually not there, right? If you experience that, I'm sure for those of you who have previously borrowed or tried applying for an SBA loan, it's just too damn slow. It's when you need your money like yesterday, you don't need to submit a whole bunch of paperwork just to be turned down or just to be, asked for another set of documentations because your uh, documents that you previously submitted have expired. So, it's a timeline trap. So speed of funding is not there, right? The debt trap. This means that the matching term of your loan does not coincide with, the financing. Yes, you may get a 10-year financing, but you're stuck with that loan. Remember, that's a loan. It's a long-term loan, so it'll be on your balance sheet, right? So you'll be stuck paying that for, say, 10 years or 7 years. Whereas for an accounts receivable financing, contract financing, or factoring, it's a short-term financing arrangement. Once the factor or the commercial finance company collects their ARs from your customer, it's done. You don't have to worry about it. Whereas for uh, a business loan, you got to worry about that for the next 10 years or 7 years. And also, the third is the approval trap. Looking backward at your tax returns or financials instead of forward, that, based on the contracts that you won is basically a trap, a hindrance for your approval. Usually, I don't know if you were here last week, we talked about historical cash flow under the five C's of credit. So that's what it is. It's a way for a bank, when I'm talking about an SBA loan or a traditional business loan, to look at your historical timeline, historical income. But what if you're new and you just got a brand new contract? So chances are you won't get approved, right? So that's a mismatch right there. And the last trap here is the asset. So with SBA, they will file a blanket lien on your business assets. It's called UCC1 filing. They all do that, especially if your loan amount is over a certain amount, usually I think it's 500,000 or less, or more, rather. They definitely would file a business asset. So it prevents you from getting finance for another business loan or another line of credit. So for that said, the execution of SBA loan may not be a well-timed product for contractors or for this type of businesses. At the end of the day, winning the contract is just step one. Executing without cash is how you actually build a thriving business. I hope this gives you a new perspective on how to fund your win. And with that said, if you have any questions, let's open up for some questions here. If you guys have anything, thank you.
Um, Edgar, so you introduced me a while back about revenue-based financial.
Right, revenue RBF, correct.
Mm-hmm. So would you tell us about the qualification? Because I thought, when you introduced me a while back, I thought it was very interesting, and then I bet a lot of small business owners might interested in.
Yes, so thanks. The RBF, our revenue-based financing, is an attractive way, but a caveat here, an attractive but an expensive way to get your business capital because they will based on your uh, the loan amount will be based on your deposits. They will look closely at your bank's historical deposits. They will have a formula where they will take into account your future borrowing base based on an average of your monthly deposits for the past, 6 to 12 months. So the idea is the revenue that you generate for the next month will depends on your monthly payment. So for instance, if your gross payment or gross revenue rather is $100,000 for this particular month, let's say in March, and it's usually high, that's your highest, then they will take a fixed percentage, usually, about 8% maybe of your gross revenue minus your base, and that would be your monthly payment. Now, let's say in April, you only made 50,000. So your fixed percentage will be less. So you're not going to pay, the percentage that you paid in March for the month of April. So it's flexible to you. So for instance, if let's say in my example, you generated $50,000, right? And they determine your fixed payment will only be, your interest, your minimum interest. So that helps you because you're not paying your principal. Now, in cases where you're making a lot of money for that particular month, then it actually accelerates the reduction of your principal. So you can pay the loan up in no time, within 2 to 3 years. It's a short term, uh, but it's a high margin, so you need at least 20% margin or maybe more. The more margins you have in your business, the better. One of the good things about this is your personal credit score is not really a primary factor for approval.
How about the interest rate about RBF?
Interest rate is generally a market rate. So it's usually, between, I would say, 9 to 11, 12%, depending on, the history of the borrower, uh, credit score, how long in business and the types of business that they do.
Thank you.
It looks like there's some questions on the webinar chat. Would you like me to answer those, Irene?
Yes, please.
Okay, so there was a question. All right, so I recently won a relatively small bid, will require purchase, sale of equipment amount of roughly 16. I would like to use this as starting point to work. What kind of, let you know the options we can work together. So uh, for smaller bids, you can actually go with, the mobilization capital. So mobilization capital is just a fancy way for lenders to offer what they call the short-term loans, which are, your weekly payments, and it's based of your fixed percentage of your deposits to qualify. Usually, it's 10% to 12% of your uh, average deposits. So if you have $100,000 in your deposits, you could qualify for $10,000 to $20,000 based off that. Another way is contract financing. If you have a signed contract, you can do so and get some advance from it. Now, caveat there is there's only a few companies out there that is willing to do that, especially if you're brand new. Your best bet really for brand new businesses is business credit cards or a combination of supplier credit and business credit cards, because especially if you have good credit score, you can get a higher, and then it can actually fund your materials purchases or equipment purchases.
There is a question from Caitlin.
Mhm. Let's see. Well, I realize these are financing options for a government contract. Are they also available for a contract from a private party? Usually, it depends on if it's a short answer is possibly, but it depends on the type of transaction. Usually lenders doesn't allow private party contracts. When you say private party, does it mean that it's just a simple transaction between individuals or between businesses? If it's between businesses, then yes, it's very possible to get financing because the lender will look at your customer's credit history. They don't have to be necessarily a big account or a big business, but at least they should have some business history or business credit score to finance those. But on individual projects, I would say no. I guess there's a follow-up. There's a question. Where do we go to get access to these various financing options? You can go initially to nonprofit organizations such as PACE or any other nonprofits, or you can speak directly to, commercial finance companies out there for these types. Nowadays, it's you can just Google and type in commercial finance company. You can even use Chat GPT for a, detailed prompt and say, find me a, relatively good list of commercial finance companies that are offering factoring accounts receivable for contractors. And ChatGPT would scour the internet and they'll probably give you a better response rather than just Googling it. Uh, Mind you, when you use ChatGPT, be specific, commercial finance company, because that to me, especially if you're a contractor or a sub, this is your best way to get financing rather than to your bank. Yes, your bank will help you to a certain degree, especially if you're an established business, usually, 5 years of history, good financials, then you don't have to worry about financing. Your bank can help you. Now, for those of you that are, you know, been in business for less than 5 years, doesn't have that good financials, credit score is fair, then commercial finance companies are usually your best bet. So there's tons out there, out there to consider. Contract financing also, when you do a prompt on ChatGPT, they will really help you uh, give you a detailed information about it. Okay, another question. Can you speak about the use of lines of credit versus credit cards? Okay, so the lines of credit usually is reserved for operating expenses. If you have a timing difference between your payables and your receivables, right? So your line of credit will step right in for you to do that. Now, with your credit cards, usually those are reserved for entertainment expenses, material purchases, and things of that nature. Lines of credit, you can use that as well, but credit cards are mostly for administrative or office purchases and entertainment as well. Typically a line of credit extended to contractors is a form of a contract financing or factoring. So you really can't use that to pay for, your meals with when you meet for your clients and stuff like that. It's always tied, especially. to factoring and accounts receivable financing, it's always tied to your receivables. Whereas for a credit card, you have a set of credit card limit. I hope that that makes sense. Okay, so there's some clarifications here. Private parties between businesses like putting marble counters into homes at an HOA. So those are private party transactions. So those are considered individual transactions. So normally lenders wouldn't entertain those. However, if you do, avail of the short-term loan, if you're an established business with some deposit history, that is your best bet to get finance to buy those materials. Or if you have some history with your vendors, they can probably extend you some credits to perform your project. In that way, you can get paid before you actually pay your supplier. I guess that's about it.
Okay, I think we are done today. Thank
Mhm.
you, Edgar, and then thank you everyone to join us. See you next week.
Thank you.